Welcome back to our series on interest rate products and market behavior. We've got Bill Addiss joining us again in the studio. Welcome back.
Pleasure to be here. Thank you, Merlin.
Now, I love having you here on the show because you answer a lot of things that I don't quite understand.
Okay.
Now, one of the things we've talked about in a lot of our informational videos is looking at the Fed's balance sheet. Now, we've seen from 2009, a huge increase because the Fed has been out there, Operation Twist, you've got QE1, 2, 3, and just propping up the bond market.
Right.
And most people look at that and say, wow, they bought a lot of treasuries, a lot of those products, that's okay, those are safe investments. But they also, in 2008 and 9, bought an unbelievable amount of mortgage-backed securities.
Correct.
And they bought the stuff that nobody wanted. So imagine you're a store and you're selling a shirt and nobody's buying this shirt. It's the most hideous shirt you have ever seen in your life. And as a store owner, you buy your own inventory with the hope that someday it will be in vogue.
Right.
So what the Fed did is bought all this subprime junk mortgage-backed securities, which are basically mortgages bundled together, and that's a mortgage-backed security. The Fed's balance sheet went, I think it was almost $2 trillion of mortgage-backed securities.
Correct.
Right now, we are in a period where they are unwinding their balance sheet. Now, with the treasuries and that type of stuff, that's fine. They just expire, that money gets given back, and they put it back where they borrowed it from.
Right.
How do they unwind a balance sheet of mortgage-backed securities?
Great question, and you're absolutely right. And this has not gotten a lot of press.
I haven't read it anywhere.
Question. No, it hasn't gotten a lot of publicity. But you're absolutely right. Just to go back in the history lesson for just a moment, before we did quantitative easing, before the Fed turned on the printing presses to buy treasuries, you're absolutely right, Merlin. They went through under the TARP program. Remember, that was the bailout of General Motors and AIG.
Troubled Asset Relief Program.
Troubled Asset Relief Program, exactly. Well, relative to the bond market, what that was is our Fed went out and bought almost $1 trillion worth of mortgage-backed securities from the banks. You're exactly right. Now, this was money they had on their balance sheet. This was existing capital. They're a corporation.
Right.
So they had retained earnings just like any other corporation. So they bought those, and you're absolutely right. They bought them at the bottom of the market. I mean, as a trade, this was a great trade. They were bottom fishing, and they literally picked the bottom of the market. Now then, they proceeded to go into quantitative easing, where they were printing up money, and they bought $4 trillion worth of treasuries. So now we've got a balance sheet of almost $6.5 trillion of mortgage-backed securities and treasuries that they own. Well, what Janet Yellen did for us as her going away present in November of last year, before she left, her final action was to institute what is now called the unwinding. Meaning, as those interest payments are made, principal and interest payments are made on the mortgages. Because again, as a mortgage-backed bond, you're getting P and I.
Yep.
Those payments go to the Fed, and they're literally not reinvesting that money back into the market. See, the Fed stopped back in 2015 buying new treasuries. They weren't adding to the treasuries, but as those treasuries were maturing, they were reinvesting the proceeds back into the market. So the size of the balance sheet did not remained unchanged. Now, since November of last year, as those coupon payments are made, as the principal payments are made on the mortgages, and as the bonds themselves start to mature, we're just basically destroying that money.
Right.
And in some cases, for the next couple of months, that monthly unwinding is going to be as much as $50 billion a month.
Yeah.
I mean, this is a substantial tightening that the Fed is effectively doing. They're pulling $50 billion a month out of the economy without necessarily raising interest rates.
Right.
They're just letting those payments be made, and then they're basically just destroying that money.
But the treasuries have a timeline. You know, you could do 3 months, you could do 6 months, 5 years, 10 years. So you know that when that expires, you get your principal back and you've been receiving interest the whole time.
Right.
With the mortgage-backed securities, this is a traded instrument. It doesn't have an expiration date. So they have to go to an open market to sell it. And, you know, as a trader...
Or continue to hold it for 30 years.
But they're unwinding it.
Well, but again, only to the extent that principal and interest payments are being made.
Okay.
So, you know, you're right, though. Some of these mortgages, if people don't refinance, if mortgage rates stay low, these could be 30-year instruments that the Fed has to wait to get all their money back. I mean, I'm not disagreeing with your fundamental premise, because you have what's here called prepayment risk.
Right.
If people prepay, well, great, the Fed will get their money back sooner. If people don't refinance or prepay, it could take 30 years for us to get our money back. You're exactly right.
You know, we've been talking about the unwinding of that balance sheet, and as they let some of these things mature, they're taking that money and then putting it back to the invisible cash register, which they've been pulling money from all along. And you know, that in itself, guys, presents an opportunity. So the conversation here was really about mortgage-backed securities and what might that do to the markets. Well, it's kind of an unknown because we don't know how that will be unwound. I think what's important with this is when you said they bought at the bottom of the market, they bought absolute garbage and stuff that was lower than junk. I mean, and now the market's more stable. We could make the argument that the Fed has helped facilitate that stability with quantitative easing.
They would like to make that argument.
Yeah, I'm sure they would. I'm sure they would all love that one. But the mortgage-backed securities that the Fed bought, with that all said, are probably a safer investment now because the people are no longer really in risk of default, so it's more stable. So they can probably make some good money. I'm thinking.
And the Fed actually has to mark their position just like any other trading account does. So they have unrealized profit and losses. And no, it is acknowledged by the market. They made a great trade. They might claim they caused the great trade, that their intercession helped the economy.
Isn't that nice?
But I mean, it's nice to be the Fed and be able to print money.
Yeah, back to my shirt example. So I buy all my shirts that nobody else is buying, and then I run an ad campaign to market how great this shirt is, and then I sell them at a premium. That's pretty much what they did.
That's what the Fed did, absolutely. But no, if they were to unwind those on a more aggressive basis, they'd be booking profits on those trades. You're absolutely right.
All right, well, as you see these things come into the market, obviously it's going to create some waves. We don't know which way that's going to be. It could add some market volatility. One thing we pointed out on different sessions has been that when they unwind that balance sheet and they let these maturities, the treasuries expire, they're putting that money back. And that means it's coming out of circulation, which means money supply is dropping. Remember, when you have more dollars chasing a certain amount of capital, what's that going to do to price? So if supply is dropping and demand stays the same, the price of that security is going to go up. In this case, that security is the US dollar. If you look at the way the US dollar has been going, it's been on a nice trajectory. And as the Fed continues to the tune of $50 billion a month, removing money from our supply, you have everybody chasing a fewer amount of dollars. We could see that dollar market start to rise even more. And as our interest rates rise, remember, people will buy dollars to hold that currency because they're getting a higher yield on their money. As the dollar rises, that actually poses problems for the US economy because a strong dollar means our exports cost a lot more money, means tourism coming in could slow down, and also means that it's a crunch for our equity market. So as we see this market and unwinding unfold, I would encourage you to be careful out there. It does present some great opportunities. If you'd like to learn more on how to trade any asset class in that kind of environment, click that link below.